impact it is going to have on your understanding or effectiveness of learning. So you just need to help. Yeah, you need to help in that research. It's just few questions you need to fill. So please don't be lazy. You just use few minutes, like 2-3 minutes, and fill it with, with your involvement. Don't just be taking something. Just fill it truthfully, please. Fill it for me. I need that input very much. Okay, so let's see what we can do for today on audit evidence. So let me try to share my screen with you so I can point to certain things from your textbook. I'm going to lecture from the textbook you already have. So sorry, you have to be reading. That is an indication that that is your standard textbook. You need to be reading from that textbook to pass the exam. It's not to say that if you read from other sources, it is a taboo. No, it's a good thing to read from other sources, but you can't read other sources without first reading this. Your other sources reading should be directed by what you are finding from the main text. All right, so this is the text. Can you see my screen?
Yes, sir.
Okay, good. So that's from chapter 11. Chapter 11 starts from page 225 of your book on audit evidence, audit procedures, and sampling. I'm not going to be too much. I don't think I can even talk about the sampling part, but I'll talk about the audit procedures in detail because you have a question to answer from that side. When we talk about audit procedures, I think it is under the broader topic of audit evidence. Yeah. So basically what we are saying is before we get evidence to substantiate the audit opinion, before you get the evidence, you need to gather the evidence. And in order we do the evidence gathering by just laying out some procedures, some tests for evidence. That's just all it is. Forget about the rest. That's just all it is. For example, if someone tells me that let's say my TA is probably using my office to do something unethical, that's a claim, right? That's an assertion by someone. He believes it is true, but before I can trust that, I also need to believe. In other words, I need to convince myself that what a person has said is true before I act. That's what every reasonable person will do. But how do I convince myself? I can't convince myself like the faith-based people do. No evidence gathered, but I just believe that it is true. That's very suicidal, very dangerous to do. So you try to substantiate the claim, the assertion by that person by gathering evidence. In this case, how would you gather evidence? I can gather evidence just by observing certain things, observing certain behaviors from my TA. Sometimes reperforming certain things. For example, I'm just using this as purely as an example, please. This never speaks any truth. So for example, a claim or part of the claim is that he's been befriending the ladies in my class in exchange for maybe marks. So the ladies want marks, and he also wants the ladies. Just for an example. Apart from observing, maybe his level of interaction with, and something like that, I can do some observation, but most times mere observation may not bring the full truth out. Yeah, well, I have observed that she is with one particular lady, and so what? That is not conclusive. So I may add a combination of other tests to validate the assertion that someone has made. So I might probably, when he marks something, he marks a script, especially those ones that are around the problem. Let's say there's this lady, they say is the girlfriend, blah, 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 or whatever. So probably I will take that person's paper and remark. In auditing, you will find a formal word for that, reperformance or recalculation. I'll remark to see that he was being professional or he has been very much biased. I can ask questions, inquiry. I can ask him, I can interrogate him about certain things, inquiry, and so on and so forth. So when we talk about audit evidence and audit procedures or audit tests, this is simply what it is. And you, right from this kind of scenario, very simple scenario, you see it to be everyday thing. We have all been doing evidence gathering, employing some procedures every day to gather evidence and substantiate something to be true or false. And it's not too far from just what I've said. That's what it is. But just that it is in that environment of auditing a company's financial statements. So you employ this common sense logic to everything we're going to do or read through over there. All right. So when you look at my screen, you see something like topic list. Topic list that you should read and understand. My lecture may not cover all the topic lists, but once you have the understanding, if you have a good one, reading to understand the rest of the text is not a problem. So we'll have substantive procedures. I'll explain what it is. And we will say something in passing. I don't think we need a whole lecture on audit estimates. It's only telling us about how we have to apply audit procedures, trying to get evidence around things that are estimates. Yes, we had a lecture on prospective financial information. We talked about forecasts, we talked about projections and other things. And we say that all these things are quite subjective because for PFI, they are very much into the future. Nobody can predict future with certainty. Similar logic is employed in the audit of estimates. They are quite, what do we call it? Judgmental. It's based on individuals' value judgments. What you think might not be what I think. It doesn't mean you are wrong or I am wrong. It's just that we see it from a different perspective. And you see so much of these things going into estimates. So how does the auditor audit to get evidence to substantiate the truthfulness or otherwise of accounting estimates? Basically, that's what it is. And it's not so much from the stuff you know from prospective financial information. I will not talk about audit sampling, but you have to know. I'll not talk about it does not mean there will not be a question. I don't even know the questions. So once I've introduced you to the topic and I've explained the topic to you, it is your job as a student who wants knowledge. Unless you don't want knowledge, you want to be a philosopher. And philosophy is knowledge about how our world works. Once you want to do that, you have the responsibility to read the rest of the text. And then as part of audit evidence is computer-assisted audit techniques. I intentionally decoupled it from, on the face of our course outline because I wanted to throw some particular attention on this because it is also attached to emerging issues in the area of accountancy, how digital technology is shaping the whole of accounting, the accounting profession, and that this issue is almost the new norm. Doing things with computers and auditing turning out to be completely computer auditing. Yeah, that's why I isolated it. But actually, it's also part of the evidence gathering thing. Because when you go to do your evidence gathering, the procedures you will pass, it's on both manual part of the business and computer part of it. But now computer part of things is taking over the manual, so it's becoming the real deal. Just that most other texts are still believing the tradition of doing the usual thing, but this is rather the norm. So expect to see more future auditing and accounting text to reflect data science more than what you have known it to be in very near future. I'll not talk about using the work of others. I will not talk about it, but you need to talk about it to yourselves. In other words, you need to read it by yourselves. It's a very small topic. In the evidence gathering, especially based on the complexity of the client, in Akan, there's a saying from our elders that Adwene Baku for true. So the auditor, even though he's supposed to be knowledgeable about his work as an auditor, may come across some areas of the client company where things are very technical, such that he will need another person or other people to actually give a valid evidence than what he will gather based on his knowledge. This is where using the work of others comes in. Using the work of others may also include the possibility of the external auditor using the work of the internal audit section of the client company. There are issues about it. There's a standard on it itself, where the auditor needs to weigh before he can place reliance on the work done by the internal audit as a function, and where the external audit can use individual employees within the internal audit function of the client company. The standard is there. You can read that standard in just 20 minutes. It's a very small standard. So you have to go and read about it. Now we're going to shift our attention to the first one. That's the real deal. So let me talk about substantive procedures. In our earlier lectures around risk, audit planning and risk, mostly on preliminary risk assessment. That's risk assessment at the planning stage, where the auditor wants to get knowledge about the client's operations, the client's operating environment, to form an understanding of whether the client's way of life makes it more susceptible to producing erroneous accounts or the opposites. This will fit so much into how the auditor does the planning for the audits. Even the kind of audit procedures, the quality and the quantity of audit staff, the logistics that he has to make available, and so on and so forth. It's very much important. You remember that around that topic, we said that the auditor, if his preliminary risk assessment indicates that this is a very well-organized company, everything is in order. Of course, you don't need a policeman to tell you to put on your seatbelt. Whilst if you die, it is not the life of the policeman which is lost. So every sensible person knows that it is his own responsibility, and of course, it is in his own interest to do that. He will always be in seatbelt. So maybe that company is like that. He believes in the fact that if he does things well, he does it for himself. He doesn't do it for the policeman. So everything is okay. The auditor's assessment of risk at the planning level will indicate that this company is very, very low probably in all the types of risk, inherent risk, control risk, so that the detection risk by nature is very small. In such a case, the auditor can just afford to do minimal testing of the systems. You can even do system testing. Oh, okay, let me look at their sales system. Oh, these controls that need to be there, I test them on samples. Controls on segregation of duties, authorization, all those things. I've tested all the critical controls, they are working. Yes, I don't need to go and take some papers called vouchers, plenty of them. And sometimes you can't even describe how dirty they are. I've done real auditing before. I joined some auditing company to do audit. My first auditor, hey, master, even if I ask UCC cleaner to go and do that job and take some money, he will come back and say he can't do it. The company was about collapsed. The building has even been taken over. So all their records are packed in some baller place. You have to go and sit in it and dig for evidence. So when everything is fine with the company, auditors don't waste time doing that dirty work. So they might test how the controls are working. If everything is okay to the best of their knowledge, they will conclude that the accounts are true and fair. Because if you make a bread from a dented container, I don't even know which other words you use. If you make a bread from a bread making container, which is not straight, which is pushed in. Okay, that's a fine expression for you to understand. Which is pushed in maybe from some side, one side or two sides. The bread you will make out from this container will take the same form as the container. Yeah, so that's the logic on which they will conclude that if the controls test strongly established and strongly working, then the accounts are produced from such systems which has these working controls. So how can a right bread container produce the wrong bread? And it doesn't make sense. So they take it from that logic that if the processes that give birth to the accounts are themselves right, then the accounts are right. That is where they test to have the knowledge that risk of the accounts or risk our factors in the organization which can produce erroneous accounts. When they test to come to the determination that the factors that can cause erroneous accounts in a company are almost non-existent or very, very, very low, then they can do this control testing. In some cases, companies' systems will not produce initial results from risk assessments that everything is that perfect. I mean, let's even borrow from the first scenario I created about a driver and then the seatbelt and the policeman. The logic in the statement I made the first time that you put on a seatbelt to protect yourself from crash to death when there is an accident. So first of all, it is about your own life. It is never about the policeman's life. And this is common sense everybody knows, or everybody ought to know. So if you don't know, it's not an excuse. But still, you find a lot of people on the road who think that putting on a seatbelt is doing the policeman some good. So it is when they are approaching a police barrier, then they put it on. Immediately they pass the barrier, they put it off. When you get, in fact, just as we have so many people like that naturally, it's the same thing about companies. You also have companies who behave similarly. As if the company is run well, it is run well for the advantage of another person, not for themselves. You are employed by the company, you get your pay from the company, you're able to take care of yourself, your wife, your children from the company, working well. So if you get things done well, you do it for yourself. The company as an artificial person doesn't have mouth to chop money. Ultimately, you chop the money. But still, we are all witnesses to a lot of real world scenarios where people behaved in contradiction to this basic common sense. Look at issues like the collapse of the banks in Ghana. I don't even remember most of the names. Capital Bank is one. Which other bank? GT. Is it GT? UT Bank. UT Bank. Sorry, before I wrongly. UT Bank and some other
You
institutions. Yeah, you want to help? Or you can join the discussion, please. And some
UT
other,
Bank.
yeah, UT Bank and some other banks, other institutions, mostly those so-called, what do they call them? Microfinance. Microfinance, a lot of them collapsed. As if they had taken good care of these businesses, the monies were going to be paid to me or my wife. So that's the reality. So auditors cannot believe that, oh, since it is the responsibility of management and the board to make sure that everything is good in the organization, so they are going to do it. So no, some board members are thieves. Some management members are criminals. So the auditor approaches the work with that skepticism. And where he does initial risk assessment, and then the color shows red. In other words, things are clear that this company has a lot of situations that will make its account go wrong. Then the auditing firm cannot afford to do minimal testing and conclude that the accounts are either true or fair, or vice versa. True and fair, or vice versa, sorry. They can't afford to do that. So that is where they will need to go beyond just mere testing of controls, and if controls are working well, you conclude that the accounts are true and fair. They will have to do more than that. Doing more than just testing controls is what we describe as substantive testing or substantive procedures. This one is just like you're going to do galamsey like the Chinese people do it with their, what's the name? Excavators, right? Not, you see, when the Chinese have not brought excavators in, there was galamsey in Ghana, but our own people, their level of knowledge about mining is so basic that it doesn't harm the earth. You just scratch the surface and gather something small. When the company exhibits that there are a lot of factors that can make the accounts go wrong, you cannot do surface galamsey to gather the evidence. You have to do deep mining for the evidence, as if you are using Chinese excavator on the Pra River trying to get gold. That's how deep you have to do the evidence gathering. And that's what we call substantive procedures or substantive testing. And it involves all the things I earlier said. You're not just going to test controls and other things. So you have to combine a lot of audit procedures like observing, making inquiries from people who can give you the evidence, reperforming, recalculating, actually confirming. You can even do what they call third-party confirmation. So the client says, okay, he has this amount of money with this bank. Well, the banks are not under any obligation. In other words, you are not auditing the banks directly. And they will produce maybe bank statements. It's not coming directly from the bank. So sometimes the auditors want to be clear. So they write confirmation letters. They want the banks themselves to confirm those figures. And sometimes they can even do it cleverly. They will not write a figure for you to confirm. If they have deals with a bank, they will just confirm to any figure that they think is coming from the client they have the deal with. So you can make the inquiry a little bit open. So they should write a figure that the client has with them. And if the client has said they have 10,000 and they write 3,000, then you know what is happening. So you do a number of things for you to get the appropriate and sufficient evidence based on which you are likely to express a valid opinion. Otherwise, your opinion will be wrong. It will be wrong from the reality. Even if it is accepted as true, it doesn't change the fact that in reality it was wrong. Later, we may come to realize it, but that's how sometimes. So you want to dodge, or you want to kind of prevent against that. You have to dig deep. That's what we call substantive procedures. So let me go to some details of substantive procedures. And auditors do this substantive testing or substantive procedures from assertions. You remember, if you remember the first scenario I gave about my TA and someone telling me about maybe some fishy deals he's making. The report that person gave me about my TA is an assertion from that person. It's a statement that person believes to be factual, but I can't believe on the surface unless it is interrogated, unless it is backed. I gather evidence around it to know if it is true or not, because someone can express bad things about someone just because that person is better than him or her. I mean, it's part of us. So that's why you cannot just believe on the surface. So I want you to understand what is meant by assertion and how the auditors do the substantive testing on the assertions to gather enough evidence to substantiate the audit claim. So the guy came to make a claim about my TA. That's the assertion he's making. And I need to test against that assertion. Okay, let's say he made specific assertion. Your TA sleeps with female students in exchange of giving them grades. This is a specific assertion. So when I'm gathering evidence, I gather the evidence to substantiate that particular claim, whether he actually exchanges marks or he gives marks out in exchange for whatever he wants to do with the girls. Yes, that's how the auditors also do it. The person made a specific claim. I cannot go and gather evidence that is pointing different direction from the claim. I cannot go and gather evidence regarding whether my TA is a thief or not. No. What he said had nothing to do about theft. If he had said my TA steals my money and blah, 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 then I try to gather evidence to substantiate that claim. So these are the assertions that management also make, as if that guy is telling me, I mean, in comparison with what the guy is telling me about my TA. The management also tells all of us, mostly shareholders, about what the accounts are. Just by the way the accounts are prepared, all the things they put on the account are claims. But normally we can look at the claims that management is making or the assertions they are making in blocks. So if they say that sales revenue 1 billion 2021, total assets 35 billion, they are making an assertion, they are making a claim that all the sales that they have recorded are true sales. I mean, we learned about some of these things when we were looking at the sales system. All of these sales, as they have recorded, are true sales, no fictitious sales. So they are sales that actually occurred. It's the same thing they speak about the liabilities they declare on the face of the financial statement. All of these liabilities are legitimate liabilities. You don't have any fictitious one in them. It also means that all calculations, because they are figures, so all calculations have been performed and everything is right. So these are the specific communications they are making with the accounts, either expressly or either explicitly or implicitly. So they are saying that there is the assertion of completeness. There is the assertion of rights and obligation. If it is about assets, they have rights to the asset. If it is about liabilities, the obligations attached to the liabilities are legitimate obligations. They are also communicating accuracy, valuation, and allocation, so that when they say this is total non-current assets, they have not wrongly classified something like a revenue expenditure. They have not wrongly, probably, capitalized it. So they are saying that everything is correct, but we see the correctness from these assertions. They are also claiming that there is existence. All the sales are existing, all assets exist, everything that actually need existence exists. That's the communication they are making through the face of the account. There is occurrence, there is right classification, cutoff is correct, right? So if those are the specific claims that they are making, then the auditor gathers evidence to substantiate these claims. Just like I will gather evidence to substantiate the claim that my TA gives marks to ladies in exchange for whatever. And that's a simple business the auditor will do. So from this angle, I believe that everybody can even read the remaining of the text and understand it. But let's do it together. So as for directional testing, tests designed to discover errors, tests designed to cover omissions, I want you to read them on your own. I want to focus on, I'll talk about analytical procedures as a substantive procedure. And I'll also talk about specific substantive procedures for specific items of the account. Where do I even have that lecture? All these things are still on analytical procedures. Okay, this is the accounting estimates and how evidence gathering on them should be carried out. It's very small information. Okay, so I think I can even complete it. I want to go to where I want you to pay attention. There are specific audit procedures or sample audit procedures for some items on the balance sheet. I think it will follow this chapter. Okay, so this is how they design the text. So now it is going to tackle how we do evidence gathering, employing audit procedures for the blocks of items on the income statement, like non-current assets, current assets, revenue, blah, 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 blah. Okay. I have given the lecture an overview on what audit procedures are. So, and I've also talked about assertions, financial statement assertions. Some people also call it simply audit assertions. It's not wrong. So when we are auditing something like non-current assets, by design, how the non-current asset schedule is prepared, management is communicating all the assertions, or at least most of them. They are communicating the assertion of existence, that the 3 billion value of non-current assets actually exists in physical assets. That's existence. Valuation, classification, they are saying that they are all valued correctly. We have some measurement standards. I mean, you are the accountant, so you know. Your friend is simple. The lower of this and the lower of cost and net realizable value. All those things are some formulas that go into valuation. So they are, by the way, I mean, just presenting it as final account, speaking that all these things are done correctly, the way they should be done by standard. But you have to test against that claim as an auditor. So with non-current assets, they are communicating existence, they are communicating valuation, they are communicating classification, and all those things. So you have to validate those claims. Okay, so let's see some of these things. I may read some of these things directly. Don't worry. Key areas when testing tangible non-current assets are, in case you want to follow from where I'm reading from, it is on page 258 on the text. You have to scroll so many pages. I've skipped so many things. Some of the things I've skipped, we'll go back to them later. I want the logic in the way I want to lecture flow. That's why I've skipped up to this level. Because we just talked about audit procedures, substantive audit procedures. We want to link the audit procedures, as we have understood them, to as if we are in the field. So if we are auditing non-current assets, we understand in theory what audit, substantive audit procedure, what are the specific ones? How would we test for existence? What would we do to actually know that something exists? What would we do as auditors to actually get the knowledge that the valuation is right, the classification is right, and so on and so forth? That's just what we want to do, because the question will ask you for those specific things. Because most of the time, the questions are case-based questions. So, key areas when testing tangible non-current assets. Confirmation of ownership. That's about rights and obligation assertion. So the right side of that assertion goes for assets, and the obligation side of that assertion goes for liabilities. And that's about ownership. Well, not probably strictly ownership, because you know in accounting, this belief of substance over form. Anyway, I want someone to tell us a bit about substance over form, the concept of substance over form. Yeah, class, you need to be engaged. I'm not the only person to talk. Substance over form. What is it? What's substance over form? Okay, maybe I need to mention names. So you carry that classroom behavior also to online classroom. This one, no friend is sitting with you. Your boyfriend is not in the class for you to feel shy of. and vice versa. So why can't you talk? Alberta Feni, Alberta, if you don't respond, you are absent. I'm going to punish you. I'm marking the rule. Alberta Feni. Alberta, you have 1 minute to respond. Otherwise, you are absent. And you will be punished for being absent. Yeah, Alberta, you can talk, please. Yeah, Alberta, your microphone is now on, so you can talk to the hearing of all of us. My question is very simple. What is the concept of substance over form? Alberta, Samuel Ado, you have to get your camera off. Sammy, we are not interested so much in your face for now. We are interested in the lecture more than the face. Later, we'll do the face kind of things. Alberta. Okay, Alberta, absent. Alexander Ban. Okay, Kwadjo, your hand is up. Kwadjo, talk.
Sir, based on the little I know, the substance over form is an accounting.
What you know is not little, please. What you know is not little. Don't come from that.
Okay, it's not little. What I know, the substance over form, it's an accounting principle that suggests we record the economic substance of transactions and events as opposed to their legal form, so that you can present a truer and fairer view of transactions.
Okay, in case I should mark this presentation, I will give it 100%, 10 over 10. But Kwadjo, if you're explaining this concept to your grandmom, anyway, I don't know, me, my grandmom didn't. I bet I'll come to you later. My grandmom didn't school. I don't know of your grandmom, but generally grandmoms don't have good education. If you're explaining this to my grandmom, the fact that my grandmom didn't and doesn't understand English and these big words, it doesn't mean he doesn't understand common sense. So explain it in common sense for even my grandmom to understand what you mean by substance over form.
Okay, sir. In mundane terms, I would say it means presenting everything in a complete and relevant manner. You capture every nook and cranny of the transaction.
Brofu ya mezi breaking down the other bakura say first. Okay, simply that concept is very commonsensical. I mean, forget about the big terms that goes into the explanation. It simply means that, like Kwadjo is saying, what he said is right too. It's just that I wanted him to be a little bit lower in the English. Alberta, okay, you want to talk, Alberta? You want to add something? Let's hear you. Yeah, Alberta, your hand is up. We are ready to listen to you. Yeah.
Yeah, I was at the library, so I was not coming out.
Yeah, Alberta, we are listening, please. I think she has a connectivity problem. Okay, Alberta. I think the connectivity is poor. So try to see if you can do something about it. It's not coming from my side, I'm sure. So check it from your side. So let's continue. So what it basically means is that, like Kwadjo said, present things in their realistic form as opposed to their hypocritical form. And I want to borrow this analogy. In reality,
Hello, say.
most people live very, yeah, better.
Sir, please. My library, so it's the Wi-Fi. I was coming out.
Yeah, that,
When you called, I couldn't
okay,
respond.
Alberta. Sorry about that. I know you are in class. Don't worry about that one. And for answering the question, you can pause because your connectivity is very poor. The internet connecting me and you
Say yes, I'm using the Wi-Fi and it's very bad.
is very, very bad. And you try to get it resolved if you can, and I'll call you later. Okay, so
Okay, say.
what I was saying was substance over form simply means presenting things from their realistic angle, the most realistic angle, as opposed to be doing things in a hypocritical way. Hypocritical because you know that this is not reality, but you do it and kind of rationalize it. And that's how most people live their lives in reality. Yes, especially the so-called religious type of people. They are the most hypocritical people. The very thing that they preach against on pulpits is the very thing they do when they turn their eyes around 360 degrees and they find nobody. And they sharply forget that they said their own God is all seeing. So he is seeing even before he even imagined what he's executing. And such is their life. Quite hypocritical. And auditors don't want to do this in their job. And all realistic people don't want to live like this. It doesn't help. You live the life because this is what you want to do, because it's the most realistic thing. So as an accountant, if you have the use of an asset, someone gave the asset to you, the person will not even charge rent. You understand? Though? The person will not charge rent. You have the use of the assets. You have all the responsibilities attached to the asset as at the time you have the use of the asset. If the asset damages, you have to go and repair it and use it. You have to send it for servicing. If it is about a car or something like that, that one, it behaves the same way as if the asset is bought and owned by you. So you cannot hypocritically take that asset from your balance sheet just because you don't own it. You have the full use of it. It's same as you own it. And forget about the legal side of things. Legally, legal is not straightforward. Legally, it's not for you. Even leasing, especially what they call operating lease, not capital lease. You have bought something, you have taken something, not bought. And the lease charges, you have to pay during the lease period. You have the use of the assets. If the asset spoils, you have to go and repair it. You do all things. What about that way of life is not speaking that the asset is like you own it, unless you are a hypocrite. So accounting wants to stop people, especially management, from behaving hypocritically to gain advantage for themselves. And that's what hypocrites in real life also do. They do that kind of life to gain, some advantage which they will not get ordinarily. So there's a law, or there's kind of an agreement within the accounting fraternity that if you have the use of the assets, everything about how you are using the assets is just like you owe the assets, just report it as you owe it. That's substance over form. The form is the legal part, the substance is the reality. Is that okay? Okay, I think that's okay. Sorry. So the things we have to kind of gauge or have our eyes on, I was talking about audit procedures for non-current asset against, you're doing the testing against the assertions. So assertion for rights and obligations, you have to confirm for ownership. And I was telling you, it's not just ownership because of the issue of substance over form. Even if you don't own it in terms of law, but you have full use of the assets, entitled, you are obliged to take all the responsibility to attach the assets during the period of usage. Then you don't own it, but you own it. So if you like, own in accounting terms and own in general terms. You own it. That's how we do it. So you test also for substance over form for confirmation. You test for inspection of you do inspection of non-current asset. This confirmation can be just seeing that the things actually exist. Valuation by third parties, adequacy of depreciation rates. These are the things mainly when you're auditing tangible assets, you have your eyes on. Confirmation of ownership, confirmation of usage. So the ownership, you also need to know about the substance of a form. So if you don't have title deeds to the property, if they don't have documents in their name saying they own it, it does not necessarily mean the ownership that we understand it in accounting. So you also have to test for usage, right to use the asset for which duration. That may also call for classifying the assets as existing. Inspection, valuation and adequacy. So let's come to 1.1, audit objectives for tangible non-current assets. The objectives will be generally across, will be the assertions, because that's what management seeks to communicate as what they want to achieve around non-current assets. Existence and occurrence, completeness, rights and obligation, accuracy, valuation, allocation, classification, and presentation. So we'll discuss them across these assertions. By existence and occurrence, you, the auditor, need to validate that claim by management. Management writing the values on the balance sheet, they are saying that all the non-current assets exist and all transactions causing them into being actually occurred. So what would you do as an auditor to test to know that this claim is true or false? What would you do? Existence. So let's see some of the things. It will guide us to also form our own thinking. Most of the things that you are thinking are true, even though they may not be on this sheet. Additions represent assets acquired in the year, and disposals represent assets sold or scrapped in the year. Recorded, this is the general things the auditor should know. And then we'll talk about the specific procedures we'll use to test them later. The general thing is that additions, they represent new assets. So if, let's say, last year, our non-current asset value was 10,000, just for example, and this year it is 20,000. Just on the face of the financial statement, management is making the claim or the assertion that there has been additions to non-current assets, and all those additions are actually existing items of PP. Yes, that's the objective. That's the auditor will be testing for. Recorded assets represent those in use at the year end. So they are there. So that it's not like the figures are pointing to the north, and when you go to see the underlying assets that they have said is existing on the balance sheet, is also pointing to a different direction. That shouldn't be the case. The auditor have to check, but people can lie. Completeness. All additions and disposals that occurred in a year have been recorded. Balances represent assets in use at the year end. Rights and obligation. The entity has rights. The entity has rights. As a client company, has right to the assets purchased and those recorded at the end of the year. Obligation side means that any liabilities are also legitimate liabilities which the organization has to pay. That's the mirror side of it. Accuracy, valuation, and allocation. Non-current assets are currently stated at cost, less accumulated depreciation. And I was telling you about these standards that regulate the way they should be accounted for. So when they put the figures out there, they are communicating that all these things have been done the way they have to be done. And it is your job to check that it is true, because they can lie. They can do something else and report that they did it a different way. Additions and disposals are correctly recorded. Classification. Tangible assets have been recorded in the correct accounts, and expenses which are not of capital nature are taken to profit or loss. Yes, that's basically about classification. And the last one, presentation. Occurrence and rights and obligations, completeness, classification, accuracy, all of those things. Presentation reflects all of them. Disclosures relating to cost, additions, disposal, depreciation, policies, useful lives, assets held under finance leases, and are adequate and in accordance with accounting standards. So that's about the presentation. Basically talking about full disclosure or disclosure of all relevant information. That's the presentation. Okay, so audit procedures for non-current assets. Now, we know what management is seeking to communicate through the assertions when they present the balance sheet and they have the PPG section. And we know when the auditor is going to audit, the objective with which he wants to audit. Actually, he's going to audit for the objective of validating the assertions, whether existence actually exists. Classification, whether classification has been done correctly. That's the objective, basically. So let's see, audit plan, tangible non-current assets. Let's see some of the audit procedures, specific things the auditor will do to kind of get the evidence for each of the assertion levels. If we take completeness, the auditor can obtain, the auditor wants to know that everything that needs to be recorded has actually been recorded. All disclosures that need to be made have been made. That's the summary of completeness. So if the auditor wants to test to see that this completeness assertion is actually there, you can do a number of these things. Obtain or prepare a summary of tangible non-current assets, showing how the following reconcile with the opening balance, opening position. Gross book value, accumulated depreciation, net book value. So you agree the opening balance with, the balance as you are seeing them with the balances that they have from the previous period, because the same statement will also capture the additions and disposals. Compare non-current assets in the general ledger with the non-current asset register. Yes, they have the same figures in two different places. So it's a way of getting how complete the recordings are. If it is the same here, the same there, then it's a measure of somehow, how complete they are. If it is different here, different there, then you can clearly see that completeness is likely to suffer. So compare non-current assets in the general ledger with the non-current assets register. So non-current assets update as they have it in the accounts with a book that they record all assets they buy. There should be an agreement. If there's no agreement, obtain explanations for differences. And the explanation will give you evidence as to whether things are complete or not. For a sample of assets which physically exist, agree that they are recorded in the non-current asset register. That's a measure of completeness. If it actually exists, but they have not captured it in the asset register, it is most likely that it is not going to also reflect in the final account, and that will not mean completeness of recordings. So you may want to test whether things are complete by doing a number of things which collectively can help you gauge that measure. So if non-current assets, non-current asset register, all the items in there are traced fully to the actual assets and all of them, there's a match. It gives you a good sense of completeness. If there's even one broken line, then that tells you what is happening with completeness. Reconcile the schedule of non-current assets with the general ledger. So the schedule of non-current assets, which is basically the asset register. If there's any discrepancy, just like we did for the non-current assets in the general ledger and the non-current asset register, you seek for explanation if it is reasonable. And that's like if it is
Hello, Joshua. Please, what's going on?
Yeah. Hello, can you hear me? Hello? Can you hear me?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes. So
Yes, sir.
I wonder why course rep just called me and said some people say they can't hear. Two possible causes. Mainly one, if your connectivity is very poor. If you are using some free Wi-Fi where the strength is like the thickness of the intestine of an ant, that's when you can hardly hear me. It's not because I'm not talking well. I'm actually yelling in my office. I'm yelling just for everybody to hear. So if you can't hear still, it's most likely your connectivity is the problem. So with all due respect, course rep, that is a challenge beyond me. And it's actually not coming from here. Yeah, so they can probably get a better internet next time. Or if they can get it right now, they can do that. And I think the network internet too is on and off. So that's really causing the problem. But let's see what we can do. And that's why I'm recording the lecture. The recorded version will flow throughout with no breakage in transmission. So all those people victimized by this kind of challenge they have to actually get the recorded version and redo the lecture by themselves. Okay, so let's make progress. What was I even talking about? Yes, we are still talking about valuation as an assertion. So an audit procedures the auditor can do. And I was just saying, you are not doing, okay, when I do, maybe checking that there is valuer certificates. Once there's valuer certificate, okay, valuation is complete. No, that is one of the numerous procedures that collectively validates the assertion of valuation. So you do checking of valuer certificates, then you come to also check for reasonableness of the valuation. Actually having your eye on the experience of the valuer, because there can be a valuer certificate, but what if they came to take any one of us? I'm not a valuer, but maybe just because of greed for money. And so some people do that. They'll go and take a job that they know they don't have the skills. And just because they know the person giving out the job, that person also not care. They will produce valuer certificate. So if you just look at the valuer certificate to say that there's valuation, it's quite deceptive. That's why you have to do other things. You have to check the reasonableness of the valuation with regard to experience of the valuer, scope of work, methods and assumptions used, valuation basis, being in conformity with accounting standards. Still on valuation, reperform calculation of valuation surplus. Yes, revaluation surplus. Revaluation as an exercise is a valuation. The companies will sit there and say, because we are using the accrual system, so things are recorded at their historical values. But the whole world is in transition. We are always moving along the path of life. So things are not constant. That's what I want to say. But so you chose to record things, the value at the time that they occurred. So 5 years down the lane, or let's say 10 years down the lane, 10 years down the lane, the values will change drastically. Please, can you see my screen?
No, sir.
No, sir.
No, sir.
Okay, thank you very much. Someone just alerted me. But now you can see, right?
Yes, please.
Yes, sir.
Okay. So revaluation, companies will just say, okay, we think if you look at the travel we have made in terms of time, I mean, 10 years down the lane, the values we are carrying are not likely to be realistic. So let's revalue based on current situations. That's what calls for revaluation. And if they do revaluation and they think the values, I mean, should be revalued upward, we get what we call revaluation surplus. You have to reperform the calculations. Not only revaluation surplus, all forms of valuations. If you can have an underlying record of how things are broken down to form that valuation, you have to do reperformance of them, recalculations of them. And that's part of confirming valuation. Confirm whether valuations of all assets that have been revalued have been updated regularly. Full valuation every 5 years and an interim valuation in year 3 generally. I mean, this is just like an example. By asking the finance director and inspecting the previous financial statement. Let me just summarize that. That's one is saying that once we have the process of revaluation, they normally have a policy of, okay, revaluation every 5 years, revaluation every 3 years, revaluation, let's say every 10 years. It depends on the classes of assets. So if that is what is happening in the organization, you have to check that once the revaluations are done, you have to go and adjust the figures in the accounts to reflect the revalued figures. That's just what it is. And the auditor needs to check that, or need to confirm that those things are done. Inspect draft accounts to check that client has recognized revaluation losses in the statement of profit or loss, unless there is a credit balance in respect of that asset in equity, in which case it should be debited to equity to cancel the credit. Although there's a set-off situation. In other words, it's saying that inspect that they have documented or the revaluation figures have reflected duly in all the accounts wherever they need to reflect. Review insurance policies in force for all categories of tangible and current assets and consider the adequacy of their insured values and check expiry dates. That's also about valuation. Because insurance premiums on non-current assets is coming into being as an expense because of the non-current assets. Of course, so they have a connection with the non-current asset and have to do the valuation. You can also see another valuation from the side of the correctness of the insurance claims if assets are revalued. Normally, the computations of the claims are done on the value of the asset. So if the asset has been revalued, how realistic are the current claims? They may not. So the auditor can also check the effect of revaluation of non-current assets on any claim adjustments, just anything that it will go in effect. Have to check that those things are also updated. That is an audit procedure. Valuation in terms of depreciation. Review depreciation rates applied in relation to assets lives, residual values, replacement policy, past experience of gains and losses on disposal, consistency with prior years and accounting policy, possible obsolescence. So you just have to peruse a whole depreciation policy. You may do a lot of re-performance even or recalculation in this area. I mean, from their own document, they say useful life of the assets is this. This is the scrap value, and this is the cost of the item. That these things gives you what the depreciation figure will be based on whether they are using straight line method or reducing balance or some other method. Apart from checking the arithmetic accuracy of the calculations of the depreciation, you may also want to check even for the reasonableness. Yes, some things may not be found here, but they are equally right. The reasonableness of the depreciation method. For example, if all the assets are not that much depreciable assets, and this is what I mean. Let's take two assets, for example. If I take my office desk, okay, let me even take my, those who have come to my office before, I have bookshelf. In fact, it's very, very old bookshelf, but I can challenge you, when you see it, you wouldn't see it as very old. It appears younger, but it's very old. That bookshelf, the wood from which it was made, I don't even know the years that this bookshelf has spent from the beginning, but it can last for the next even 100 years. I don't want to say forever. So it is not too depreciating in terms of value. How it was the very first day they brought it, let's take it like maybe 20 years. It can be more than 20 years. So 20 years ago, it appears the same way as it appeared 20 years ago. You can come and check. So it is not too depreciating. If you are dealing with assets whose nature is like what I'm describing, and then you have depreciation method like reducing balance. Yes, it's a method that is used, but the reasonableness. Reducing balance is on the notion that that asset wanes. It kind of loses value. It loses its real value, its usefulness, so to speak, through use. Of course, every asset uses its usefulness through value. But this one, what I'm trying to say is that it is very clear. It follows that pattern clearly. Something like vehicle. A vehicle bought now, brand new, tear rubber. Its usefulness is at the highest, is at the peak. When it is used 1 year, you don't get the same usefulness as the previous year. 2 years, not the same as the previous year, and so on and so forth. So you clearly see that it just follows that logic behind reducing balance. So there should be reasonableness behind the depreciation method you use. But the one I just described you, value 20 years ago, the same value today. I mean, reducing balance is the most fitting method, so that the value by which you think the assets goes down in usefulness is the same across all years, or the benefit you think is derived from the usage of the assets is the same every year. The utility I get from using this bookshelf now is the same as the utility they gained 20 years back. So you look at the reasonableness and the policy. The auditor needs to check these things and advise. Mainly, that's what we want to pick from there. Review non-current asset register to ensure that depreciation has been charged on all assets with limited useful life. For revalued assets, ensure that the charge for depreciation is based on the revalued amount. I mean, you know this from accounting. By recalculating it for a sample of revalued assets. Reperform calculations of depreciation rates to ensure it is correct. Compare ratios of depreciation to non-current assets by category with previous years' depreciation policy rates. Scrutinize draft accounts to ensure that depreciation policies and rates are disclosed in the accounts and they are consistent. Verify title. Okay, we are moving to another assertion. That is rights and obligation. And by this assertion, management is communicating that every non-current asset they have put on a balance sheet or the statement of financial position actually is owned by the client company, or at least it is possessed and used. That's the substance of a form, and used by the client company. That's what they are claiming on the face of the financial statement. That's what we call rights. On the side of the asset, that will be rights. So let's read what we have here. Verify title to land and buildings by inspecting title deeds, land registry certificate, leases. Yes, they say they have rights to it. The rights can come in the form of ownership of it, or, substantively using the assets, even if they don't own it. And you can substantiate rights to the assets by checking. This is more for ownership. Title deeds, land registry certificates, leases. You are testing it for assets like land and buildings. Obtain a certificate from solicitors or bankers stating purpose for which the deeds are being held. Custody only. Stating deeds are free from mortgage or lien. So in some particular situations, maybe these documents may be in the possession of lawyers or bankers. You can obtain evidence from them regarding issues surrounding their rights and obligations. Inspect registration document for vehicles. It's about rights and obligations. You say that thing, you possess it substantively, you own it. We are checking it. Inspect registration document for vehicles and land. Vehicles held. If the vehicle is for you, there's no question about the fact that you own it, and that if it is part of the non-current assets, it is right. If the vehicle is not in the name of the company, then further procedures need to be put forth to substantiate whether it is correct for the company to put them or to add them as part of their non-current assets. Confirm all vehicles are used for the client businesses. Well, the business can have the registration document of the vehicle in its name. The client company can have the registration documents of the vehicle in its name, only that vehicle is always used by the MD's wife. MD's wife is not even an employee in the university. He uses it to go to his own work, carry his children, do his own things. In that case, substance over form applies. That vehicle can never be recorded as a non-current asset for the organization. These are the issues. Examine documents of title for other assets, including purchase invoices, architect certificates, contracts, hire purchase, or lease agreement. Review for evidence of charges and statutory books, and by company search. Okay, so that's a few things on rights and obligation, about 2 things more. Review leases for leasehold properties to ensure that company has fulfilled covenants therein. Examine invoices received after year end. Orders and minutes for evidence of capital commitments. Yes, these are the procedures and more that you can do to kind of substantiate management's claim that there is right and obligation regarding non-current assets. Additions. This is not an assertion on its own, but it kind of supports other assertions. These tests are to confirm rights and obligations. Of course, like I said, it's just to support validation of other assertions like rights and obligations, valuation and completeness. So for addition of non-current assets, verify additions by inspection of architect certificate, if it is building, for example. If they have said there are new buildings which is causing the building's value to double, plus, and so on and so forth, you can substantiate the addition by first of all inspecting architect certificate, solicitors completion statement, suppliers invoices. It depends on what the asset is. Review capitalization of expenditure by examining for non-current assets additions so that they don't misclassify. So this goes to work with valuation and completeness. It will also have to work for what do we call it? Classification. Yeah. Inspect non-current asset account for a sample of purchases to ensure they have been properly allocated. So that's about addition. This addition thing actually helps you to do other assertions, not an assertion on itself. If it is a self-constructed asset, what are the audit procedures specific audit procedures you can pass across to validate any relevant assertion? So it's telling you these tests are to confirm valuation and completeness, self-constructed assets. Verify material and labor costs and overheads to invoices, wages recorded, etc. So if you verify and everything matches, it gives you an indication of completeness of the accounts. If there are some broken lines, it also gives you an indication about how complete the accounts are. Valuation will also be there. Ensure expenditure has been analyzed correctly and properly charged to capital. Expenditure should be capitalized if it is, and you know all the criteria for capitalization. If it doesn't meet the capitalization criteria, it has to be expensed in a profit or loss. So that's about if you have you did a self-construction of the assets. Disposals, you have specific procedures that will help you validate other assertions for disposals. For example, verify disposals with supporting documentation, checking transfer of title, sales prices, and dates of completion of payments, etc., etc., etc. The etc. things are there. Please go and read on them. Classification as an assertion. Classification, you are basically going to make sure that what they have documented as non-current assets is truly non-current assets and not a misclassification of some revenue expenditure that is finding itself into the non-current asset account. Basically, that's what it is. So the auditor is going to pass procedures to validate whether management did everything as it's supposed to be done, or there were some wrong things somewhere, so that the auditor will alert the management to correct those things. So these are some of the things the auditor can do. Review non-current asset disclosures in a financial statement to ensure they meet IAS 16 criteria. IAS 16 basically tells you about what is a non-current asset and what is not. It gives you at least some information on what can be capitalized and what cannot be capitalized. So you will review to make sure that the accounting for non-current assets meets strictly the IAS criteria. In exam, if you write a specific things in IAS 16, that's better. For a sample of fully depreciated asset, inspect the register, the asset register, to ensure no further depreciation is charged, so that it doesn't become like an asset is disposed of, but depreciations are still calculated. Normally, these things can happen if we have some semi-automated system, and it's like when we are looking at this side, we are blind on the other side. So the asset is disposed, but calculation of depreciation still is carried on it. That will be wrong classification. And that will also affect valuation. All right, so basically these are the main audit procedures. You can think of many others on your own based on the understanding we have formed so far, which may not be here per se, but they are equally correct, because we understand the accounting thing, and we understand the objective that the auditor is performing the audit procedures. We understand what goes into each assertion that the auditor is gathering evidence for. So we can generate a lot of audit procedure that the auditor can do to validate any assertion. For example, existence, to check that what they have recorded actually exists. We can write some other things apart from what is being put there, and it's equally correct. So that's basically about audit evidence in relation to specific income statement items like non-current assets. You will find very similar audit procedures with other other financial statement items like current assets, like inventory, like cash and bank. Okay, so the rest of the book is carried out in that fashion. So you see intangible, okay, they are also talking about intangible non-current assets. We know from accounting the nature of intangible assets. And we know the assertions that management communicates when they put that value on the balance sheet. And we can have an idea of what the auditor will want to test to validate the assertion being achieved or not. So you can, by yourself, generate a lot of things that you can do to check whether this thing management is saying is true, to check whether it is true or not. You can do most of these things without being an auditor. And that's how commonsensical some part of auditing can be. It's not too technical. I want us to move to, okay, this is about inventory. So you will have to read about inventory. We've gotten a very good understanding of audit evidence, but specifically how the auditor gathers evidence on specific financial statement items, which we just talked about, non-current assets. The same idea should be borrowed to do inventory as a financial statement item. When you read, you will understand. I promise you that. And okay, that's inventory. So let's see what other thing that we need to read on. Okay, so inventory will have a lot of issues with cutoff, especially inventories moving in at the year end. If you don't take care, it may go into the other period, and that will be a wrong cutoff. Okay, I want to see the next one on the list, receivables. So you need to read about gathering audit evidence around receivables. This guy, we are just closing and you are now coming in. So from receivables, we go to cash and bank. We go to cash and bank. Please, are you following? So you will have to know the assertions for cash and bank. Normally the assertions are all or some of the assertions you have already talked about. The audit procedures the auditor can employ to gather evidence to validate the assertions from management. Cash and bank. Please read on the cash and bank. You have to read on all of them, but it's just like I'm giving you one apple. Cash and bank may be there. Even at this time, I can say it may be there. Yes. Cash and bank and others. So I'm giving you one, which means that to be in the safest position, you have to read about all of them. I mean, once we've gotten the understanding, reading and understanding the rest will just glide straight. Yeah. So I think it will end with cash and bank. Cash and bank. Okay, we may have something like revenue and other things, but concentrates on, I think, balance sheet items more than the income statement items. Okay, so this is what I have for you. Not conclusive anyway, on audit procedures. I mean, as part of audit evidence. Any questions? Hello, any questions? Are you there?
I say you are here.
Any questions?
We
My
are here.
people, any question?
No questions, sir.
Okay, no question for Tengi. But Tengi cannot know what is in your mind. If you have a
No
question,
questions,
it's
sir.
good that if you have a question. Okay, no question. Everybody, no question. Okay, I see some questions from some people in text message form. Evelyn, Edu. Okay, Evelyn was just alerting me that he could not see my screen. Okay, that's the past deal. Lily, I see Edu, is saying that, sir, please, how is obtaining evidence on these items in a financial statement different from the transaction cycles and related controls? Okay, so that's what Lily wants to know. Lily, I understand this is an intelligent question. These two issues might cross carpet somehow. They might have some overlappings, but something like the sales processing system is not an item on the balance sheet. It's a system. A sales processing system is a system to take care of the sales we are making, documentations on them to make sure everything is accurate. So we don't put anything like sales processing system on the balance sheet, but we do put non-current assets on the balance sheet. So it's like they are different concepts, but inside them, of course, you will see certain things which overlap, most especially about the testing procedures. The testing procedures, for example, let's go back to the example I gave you. If I want to test the truthfulness of the claim against my TA, right? The procedures I will use to do that, it will be very similar to procedures that I will employ to substantiate another claim, like let's say my TA is a thief, he's been stealing my books and probably my cash. It will employ similar testing, similar procedures. So you see a lot of similarities. It doesn't mean they are saying the same thing. If I can use this formula to probably solve a problem in management accounting and use the same formula in solving a problem in quantitative methods, it doesn't make quantitative methods and management accounting like the same thing. They are similar on that point where they can employ the same tool to get solution. So similarity is there, but they are not the same. I hope my statement answers your question somehow, Lily. Ivy, sir, please, can we get access to the previous recorded? Thank you very much, Ivy. In fact, I think I have put it there. Oh, yeah, Ivy is there. It's because one, you have not subscribed to my Google, YouTube channel. You haven't subscribed to my YouTube channel. I put all my videos on my YouTube channel. Just subscribe. You will not pay money for the subscription, okay? And please, all those who have not subscribed, just subscribe. Subscribe, Keke. There's no pain to the subscription. So if you had subscribed, you had even gotten first time notification when the video dropped.
I'm subscribed. I'm subscribed
Okay,
to the
sir.
channel.
Okay, so if your data is not off. Oh, which one? Let's be specific. Which
like
one?
the one on I'm
Self
coming.
control.
I think we have only 2 videos over there right now. Like
I checked
Okay, which is
this
not
morning,
there.
and
So
we have
what may be there, maybe?
Sir, please, control is not there.
Evelyn? No, someone was speaking, I didn't hear. But on the issue of what is there and what is not there, you want a certain lecture to be there, and that lecture is not there. Let me know, okay, lecture on test of transaction cycles and related control. That lecture is not there. Lecture on this thing is not there. Which lecture? Not all lectures were recorded. Remind yourself. Not all lectures were recorded. And I think there is one lecture that the recording went bad. I think that lecture even didn't take effective. It didn't take place effectively because they were on and off linkage. So that lecture, the recording was not good. Apart from that one, all virtual lectures I record. The lecture on PFI is there. It was PFI and
Yes.
forensic
The one
auditing
on the
together. That
cycle.
lecture video is there. It's about 2 hours or so. Yes. So except the other lecture that couldn't come up because of connectivity issues, all the virtual lectures are there, and this one is going to be there. So this is the only lecture I owe you for now, and I owe you because it's not even completed lecture. So tomorrow it will be there. It will take time for the processing of the video. So I'll have to leave it and go. By tomorrow it will be done processing. And then I'll put it on the platform for you. Is that okay?
Okay, sir.
Okay. And one last question I think this should be the last question. Alexander Ban, the first lecture on the test of controls is not there, but the second lecture is there. So that's what I'm saying. The first lecture, you remember the lecture went very bad. The internet connectivity in my office was very poor. See, at first we even thought of canceling it. And then later I realized it has come. In the middle of it, it went off, so I couldn't record that lecture. So that's the only lecture that's going to be missing. Okay. Thank you very much if there is no question. And maybe we'll kind of do another virtual lecture that will focus on not maybe, I think I have to do it tomorrow. I'll do that on the, what do we call it? Computer assisted audit techniques. Before that, read on it. Thank you very much.
welcome, sir. Good evening.
Hi.